Let's look at how you prepare a cash budget. The cash budget is useful because it looks at how cash flows into and out of the business and gives us an idea if there's any need to finance a short-term deficit or if we're going to have a surplus that can be carried forward. Now, typically we look at a cash budget over a 1-year period, but we can also divide it into smaller intervals if we have a lot of seasonal fluctuations or there's a lot of uncertainty in the cash flows. So what we do is we usually begin with a sales forecast. Sales are generally easier to forecast than a lot of other things. You have a lot of data on sales, how much you've sold over the last year, 2 years, 10 years. You can sort out the seasonal variation, etc. So let's look at an example here. And this example comes from Principles of Managerial Finance by Gitman and Zuter. Now, here's the general form, which looks a bit confusing, but let's take a look. So you look at January, and you have a certain amount of cash receipts, and you have a certain amount of cash disbursements, okay, certain amount of money you've paid out, and when you subtract the disbursements from the receipts, you have a certain net cash flow. You also had some cash at the beginning of the period, so we can add that in, and you have an ending cash balance. Now, you've decided you have to have a certain minimum cash balance, and so you subtract the minimum cash balance from the ending cash balance, and if you have more than you need, then you have an excess cash balance. That's what this XXF is. If in February you subtract it out and you're actually short, you don't have as much as you need, then that's how much financing you're going to need. You'll also notice that your ending cash balance for January is the same as your beginning cash balance for February. So you can see they have an arrow pointing to the from the ending cash balance in the previous month to the current month's beginning cash balance. Now, this is kind of confusing, so let's take a look at an actual numerical example. And you don't begin with this. What you're going to do is you're going to look at cash receipts first, and then you'll look at cash disbursements, then you can put the two together. All right, so here's the example. We have this company, a defense contractor, and they're preparing their cash budget for October, November, December, and they have sales in August and September were 100,000 and 200,000. Sales of 400,000, 300,000, and 200,000 have been forecast for October, November, and December. So they have some actual data, and they have some forecasted data. And they've noticed that historically, 20% of the firm's sales have been for cash, 50% have been collected after 1 month, and the remaining 30% are collected after 2 months. In December, Coulson will receive a $30,000 dividend from stock in a subsidiary. Okay, so let's see how this all plays out. Let's look at the numbers here. Okay, so up here we have the sales forecast, or in this case these are actual numbers, these are forecasts. And how do we work out these numbers? Well, the assumption is historically we found that 20% of sales each month are paid for in cash. So if they sold 100 in August, they get $20 in cash. Okay, 20% of the 200 they sold in September, they get 40, 80, etc. Okay, now after 1 month, half of sales get paid. Now we don't know what happened in July, so we have nothing here for August. But this 50 here is 50% of 100. So we sold 100. Half of that will be paid 1 month later. And you'll notice that half of September sales get paid in October. So that's 100 there. Half of October sales, 400, get paid off in November, etc. And then after 2 months, the rest of it gets paid off. So this is 30% of August sales in October. So 2 months later, the people who didn't pay off their balance, right? If you add these up, 20 plus 50 plus 30, that adds up to the $100 in sales in August. And in November, you collect on 30% of the $200 you sold in September. Okay, so you add down each column, and you can see that in August they get $20 in cash. In September they get $90 in cash. In October they're getting $210 because they get their cash from their October sales. They get some money from August sales. They also get some money from September sales paid off the accounts receivable, and you add those up. All right. Now we want to look at their disbursements, how they're paying out their money. Here's the assumption. Again, we need to make these assumptions, and usually they come from looking at historical data, and if we have enough data, we can usually have a pretty good forecast of how we pay out our how we disperse our funds, and also how money comes in. So the assumption here is that purchases will represent 70% of sales, 10% will be paid immediately in cash, 70% is paid the month following the purchase, and the remaining 20% is paid 2 months following the purchase. Okay. The firm will also expend cash on rent, wages, salaries, taxes, etc. So let's see what this looks like. Okay, here we go. Remember that in August they sold $100 worth, and the assumption is that 70% of sales will be their disbursement. So they expect to disperse $70 in August. They expect to disperse in September. They had $200 in sales, so they expect to disperse $140. In October they had $400, so that would be 70% of $400, $280. And then in the first month, 10% are cash purchases. So 10% of the $70 disbursement will be made in cash. So $7 in the first month, 10% in September, 10% of 140 is 14, etc. Now you have these lagged periods. After 1 month, they will pay off 70% of their previous month's balance. Their previous month, they not balance, but their previous month's sales. So 70% of 70 is 49. 70% of 140 is 98. 70% of 280 is 196, etc. Then they have lagged 2 months. So in October, 20% of August numbers will be 14. 20% of September's disbursements, 20% of 140 is 28, etc. They also put in some assumptions here of wages and salaries. Remember, they're forecasting for October, November, and December. They only put in August and September to help us forecast for October, November, and December. They obviously had wages and salaries here, but we don't care about those. They don't really matter. They have some tax payments. And so now you look at these and you add up all these disbursements, and you can see how much money is flowing out each month. Okay, so in October, $213 is flowing out. In November, $418, and in December, $305. All right, now we want to sort of put these things together. We want to combine this to get our cash budget. And again, we have some more assumptions to make here. At the end of September, Coulson's cash balance was $50,000. They have 0 notes payable. They have 0 marketable securities. And they want to maintain a cash balance of $25,000. So let's take a look at what their cash budget looks like. All right, they had $210 in cash receipts. Okay, that comes from the first part of the example we did. They had $213 in disbursements. That was the table we just did, the disbursements table. So they had a net cash flow of -3. Okay, $3 flowed out. they had $50 in cash. That was their beginning balance. So their ending cash was 47, and it said they wanted a minimum cash balance of 25. So they actually have excess cash of 22. So even though no money came in, they're okay. This ending cash balance now becomes November's beginning cash balance. And again, you get these same numbers from the previous table. They had 320 coming in November. They had 418 going out. So they were minus 98. Now they're minus 51. And they want a $25 cash balance. So they're actually $76 short. So they need to finance, they need to raise $76 to get back to this minimum balance of 25 that they'd like to have. And then their negative 51 goes in here as their beginning cash balance for December. And again, same thing. If you go back to the previous calculations, they had cash receipts of 340, disbursements of 305, so they had $35 coming in. They had a negative 51 balance, cash balance previously, so they're minus 16, so they still need to raise 41 in order to balance out get back to their minimum balance. All right, so your final evaluation, here they have excess funds, so they're going to buy some marketable securities. Here they're going to have notes payable of 76, that's their shortfall in November, and 41 in December. So we get a pretty good idea of how money is flowing into and out of this company. So this is a very useful way for a company to look at its financial position, perhaps to plan ahead in terms of setting up a line of credit with their bank to make sure they have sufficient funds to keep operations going.